Assalamualaikum, salam sejahtera. My name is Dr. Ridwan. Now we at this module 3, and for this chapter, it's about the cost, volumes, profit, CVP analysis. Okay, the learning outcome for these chapters are to make sure that you understand what is cost, volume, profit, CVP analysis. And so the second learning outcome is to make sure that you know and understand what is the break-even point, or we call a BEP approach in CVP analysis. Let me dive into understanding this powerful tool that help businesses navigate through a crucial decision affecting their profitability. So the CVP analysis, also known as break-even analysis, is the fundamental tools by company to assess how changes in volume on cost, revenue, and profit impact their profitability. Then why this CVP important? This is because in businesses, CVP analysis guiding them in predicting the effect of their decision on sales, cost, and net income. So if you can see from here, okay, you can see from here. The CVP analysis estimate the profit based on selling price, sales volume, unit variable cost, and total fixed cost. So the selling price of the product or services directly impact the revenue. Right? The CVP analysis help determines the optimal selling price for maximizing profitability. Then we look into the sales volume. In terms of the sales volume, is drive a revenue, and so CVP analysis actually help the businesses to set realistic sales target and assess the impact of volume changes on profitability. And then the third one actually is a unit variable cost. We should understand that the variable costs fluctuate with productions or sales levels. So which means that CVP analysis evaluate how changes in unit variable cost affects total production cost, and consequently is a profitability. So last but not least, actually the fixed cost. The fixed cost remain constant regardless of productions or sales level. So the CVP analysis help determine the break-even point where total revenue equal to total cost, cover fixed cost, and achieve profitability. Okay, the cost, volume, profit, and CVP analysis model is indispensable tools for businesses by considering factors such as selling price, sales volume, unit variable cost, and total fixed cost. So the company can make informed decisions how to make profitability and achieve long-term success. So now let's visualize the CVP analysis model through this graph. Let's elaborate how the company start making money after surpassing the break-even point. So this is the break-even point. So this is the break-even point. If you can see from here, it illustrates the intersections of total revenue. So this is the total revenue and total cost. So this is the total cost. The break-even point and area of profit and loss. So in this class, the BEP itself, where the total revenue cost intersect the total cost curve. So this represent the level of sales with the company cover all costs. So they cover all the costs, resulting in zero profit and loss. So at this point, you don't have profit or either loss. So after surpassing the break-even point, which is the point where the total revenue exceeds the total cost, then the cost start making money. So let me illustrate this. Um, the actually the break-even point actually represent by the left side of the graph, the total exit total revenue. So in this regions, which is the company operate at a cost, which means that this could be due to the fixed cost being higher than revenue generated at the lower sales value, because after you cannot, this is the fixed cost. So at the break of the, at the break of this point, the BEP point, total revenue equal total cost. It means that the company neither make a profit and nor loss. This is the point where the sales volume cover all fixed costs and the variable costs. Not only fixed costs, but they also cover the variable costs. So beyond the break-even point, represented by the right side of this of the graph, the totals, the totals revenue, the totals exceed the total cost. This surplus between revenue and cost represent the profit zone for the company. So as the sales volume increases beyond the break-even point, the company profit margin widens, leading to increased profitability. Therefore, once companies surpass the break-even point, so this every additional unit sold contribute to possibility to the company profit. So leading to the growth in the net income or sales volume increases. So this demonstrates the importance of surpassing the break-even point for businesses to generate profit and achieve financial success. Okay, let's break down each of the assumptions of the cost volume profit or CVP analysis. So the first one, actually, the revenue is a linear. What it means? So these assumptions apply that the relationship between sales revenue and sales volume is linear, meaning that revenue increases profitably with the sales volume. In other words, there are no non-linearities or sudden shift in revenue due to changes in volume. And then the second one, actually, the manufacturing firms operate within the relevant range. Okay, it means that the relevant range refers to the range of activity such as production or sales volume within which the assumption of the CVP analysis remain valid. So these assumptions state that the company operation fall within this relevant range, ensuring that the relationship between cost, volume, and profit remain consistent. Uh, so the third one, the efficiency and productivity are to be unchanged. It means that these assumptions apply that the firm's or the company efficiency and productivity level remain constant across different levels of activities. So, in other words, there are no changes in the efficiency or production or the productivity of level of machinery as sales value varies. So, and then this one, if in terms of the relative proportions of different products sold are constant. It means that when the company deals with the multiple products, this assumption suggests that the mix of proportions of sales among these products remain constant. So this ensures that the analysis accurately reflects the impact of changes in volumes on overall profitability without considering fluctuations in product mix. And then number four, actually just talking the assumption, I think is about the costs are linear. The costs, the costs are linear, which is these assumptions, state that the cost can be accurately represented by linear functions. So the fixed costs are assumed to remain constant. Um, over the entire relevant range of activity, and variable costs are assumed to remain constant per unit of activity. So this simplifies the analysis of assuming constant cost structures regarding the changes in volume. And then this one under the selling price is constant. It means that okay, these assumptions apply that the selling price of the product or service remain constant regardless of changes in sales volumes. So it applies the analysis by eliminating the needs to consider price fluctuation as the factors affecting profitability. And then the last but not least, the inventory, in terms of the inventory, do not change. It means that do not change. We mean that the specifically relevant to manufacturing company. So this assumption state that the inventory remain constant, meaning that every unique product is sold. So this simplifies the analysis by ensuring that there are no changes in the inventory level that could affect the cost structures of profitability of the companies. And then overall, we can say that these assumptions provide a framework actually for conducting the CVP analysis under simplified conditions, allowing businesses to gain insight into the relationship between cost, volume, and profit to make informed decisions and strategic planning. However, actually, it's important to recognize that in the real world scenarios, so these assumptions may not always hold true, and adjustment may be necessary for more accurate analysis. Okay, now let's go through the limitation of the cost, value, and profit CVP analysis in the way that you can easily understand. So the first one, assume assumptions that don't cover common business scenario. So actually, CVP analysis make certain assumptions about steady revenue and cost patterns. However, in real business situation, there are often fluctuations caused by factors like supplier volume discounts or special customer deal. So these variations can't be accounted for the traditional CVP models. And then number two, actually, it's difficult to distinguish costs as variables or fixed. While CVP analysis assumes a clear line between variables and fixed costs. Some costs behave in a mixed manner. For instance, certain overhead costs might partly vary from production level and partly remain fixed. So it can be challenging to accurately classify such costs in CVP analysis. And then the third one is actually uncertainty, about the sales volume and demand. Okay, so the forecasting demand actually is a crucial for CVP analysis, but it is not always accurate. Additionally, because the competitions in the market can affect the sales volume unpredictably. So this uncertainty. This uncertainty actually make it challenging to ensure that our product and manufacturer will indeed be sold as planned, which is an assumption of the models. Okay, and then uncertainty. Uncertainty can lead, the assumptions violations. Due to uncertainties in the business environment, is it possible for the assumptions of a constant selling price, constants, variable cost per unit, and constant total cost to be violated. So changes in market conditions or unexpected events actually can disrupt these assumptions. Okay, so and as well as affecting the accuracy of the CVP analysis result. And then the feasibility, in terms of the feasibility of cost classifications. Okay, so while the CVP actually CVP analysis assumed that all costs can be neatly categorized as either fixed or variable. So in practice, this might not always be feasible. Some costs may not fit readily into either category, making it difficult to accurately apply the CVP model to the real world situations, the real world scenario. So, okay, and then, okay, this additional point actually about the limitation of the CVP analysis. The selling price may be reduced to achieve greater volumes of sales. And then the volume through, important is not the only factors affecting the cost. Factors such as efficiency, productivity, war, government legislations are also affect the cost. And then the variable cost per unit is assumed to be, constant. However, variable cost may fall as volumes increases and trade discount or economic of large scales are achieved. So and will then rise with this demand for resources exceed supply. And then, last but not least, fixed cost is fixed only within a given given time span and over a given range of activity, called the relevant range. So, fixed cost may change from the budget year or and or when the activity level changes too greatly. So, is not normally become permanently become fixed. So this is the limitation of the CVP analysis. So thank you for joining our sessions on the CVP analysis model. We hope you find it insightful and valuable for understanding our business analysis and decision making. For the next sessions, we will learn and understand about method of determining the break-even point. So the BEP. Thank you.